tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hello, folks. This is David McKnight. Welcome to the Power of Zero show. Today is our 100th episode. Not only is it our 100th episode, it is our 100th consecutive episode. We have not missed a week since we started this about 2 years ago. So appreciate all of you who have been with us every step along the way through all our fits and starts, and you've stuck with us. And I think we've got a great show, and it's, I think, mostly because so many of you tune in and listen each week. I am the best-selling author of The Power of Zero, Look Before You LIRP, The Volatility Shield, and as by now, coming November 17th, Tax-Free Income for Life. And just to reiterate, if you want to be able to, you can pre-order it now. And if you go over to davidmcknight.com and hit the button that says redeem my free chapter, you can instantly download chapter 1. So you don't have to wait until November 17th. You can get at it right away. It'll give you a little teaser of what you can anticipate once you get the book. Today, I would like to talk about something, a benefit in the tax code that I think goes largely ignored, or if it is utilized in entirely the wrong way. Now, as you have heard from past episodes, I like to talk about the holy grail of financial planning. The holy grail of financial planning is an investment that gives you a tax deduction on the front end. Your money grows tax deferred, and you can take that money out tax-free. And the way that we have primarily done that in the Power of Zero paradigm is through a combination of Roth conversions or LIRP conversions, you skinny down your tax-deferred bucket to the ideal balance such that the amount that you take out is equal to or less than your standard deduction, but also small enough that it doesn't cause Social Security taxation. For most married couples that don't have a pension, that's going to be on the order of $300,000 to $350,000. Think about it. When you put money into your IRA, you got a deduction. That money grew tax deferred, and then you took it out tax free. That is what I call the holy grail of financial planning. You got a deduction on the front end, you grew it tax deferred, you take it out tax free. There are only 2 ways to accomplish that in the U.S. tax code. There's only 2 ways. I've talked about it till I'm blue in the face in all of my books and on this podcast. And I've also said that there is a second way to accomplish it. There's a second little tax-free diamond in the rough, as it were, in the U.S. tax code that accomplishes everything that tax-deferred bucket accomplishes when you have it offset by the standard deduction. And that is an HSA, a health savings account. A health savings account can also be technically construed as a holy grail of financial planning. Why? Because when you put money into your HSA, you get a deduction for it. That money grows tax-free, okay? So you don't have to pay any tax on the interest or the investment earnings along the way. And then when you take it out for qualified medical expenses on the back end, you don't pay any taxes at all. Why is that a big deal? Let me just give you a quick example. Let's say you don't have an HSA and you're setting aside some money for some family medical expenses, and you earmark $4,000 from your paycheck for family medical expenses. If you're in a 25% tax bracket, just to make our numbers easy, you're going to pay $1,000 to federal tax, which means you now have $3,000 left over for your health expenses. If you instead contribute that money to your HSA, you contribute $4,000, you get really a tax deduction on that. And so you're able to spend for all $4,000 of those dollars on your healthcare expenses. Okay. So you have essentially the government is giving you $1,000, allowing you to keep $1,000 of your own dollars to be able to spend on healthcare if those dollars are earmarked within a health savings account. Okay. Now, this is not going to be a long podcast today because I think I can get straight to the heart of where most people go wrong when it comes to health savings accounts. What people generally do when it comes to health savings accounts is they take advantage of two of the three tax advantages of the health savings account. Remember, there's three tax advantages. A lot of people call that the triple tax advantage of the health savings account. You get a deduction on the front end, the money grows tax-free, you take it out tax-free. Most people, everybody, is taking advantage of the tax deduction on the front end, and they're taking that money out tax-free when it is used for qualified medical expenses. But what they're not doing is they're not taking advantage of the tax-free interest and investment earnings that you could potentially be experiencing along the way. And let me explain to you why. What most people do is they put money into their health savings account, they get the tax deduction, and then that year or perhaps the next year, they take that money right back out and they use it for to give themselves a reimbursement for a qualified medical expense. So they experience the tax deduction, which is great. They took the money out tax-free, which is great, but there was not any tax-free interest on the investment earnings within the HSA that occurred along the way. They put that money in and they took it right back out. So there was really no tax-free interest that accrued in that account. Remember, these accounts can grow in investments. They're designed to grow in investments, which means that if you want to have a huge tax-free sum of money by the time you retire, you could potentially go about this HSA in a completely different way. Here's how you might consider doing it. Instead of using this as your little slush fund for healthcare expenses while you're young and you're not experiencing a lot of really intense medical expenses, what you might consider doing is pay for those smaller, less intense medical expenses, pay for those just right out of pocket. Pay for those out of your savings account or out of your paycheck or out of your after-tax dollars. Let those precious tax-free dollars inside the HSA experience that third tax advantage, which is let's allow that money to grow in a tax-free way between now and potentially when you retire, when you may have some more intense and more costly medical expenses. And let's face it, when we retire, that is when we typically have the more expensive medical costs. And what did you do along the way? By paying for those expenses out of pocket, okay? And what you might also want to do, by the way, is if you want to, you can pay for those expenses out of pocket, okay? Keep the receipt showing that you, and the copy of the check or the credit card statement or whatever, keep that on hand. There's nothing that says that you have to get the reimbursement from your health savings account in the year that you make the purchase. So you can keep all of the receipts that you paid for all of these medical expenses along the way. Let your HSA accumulate tax-free. Let it build a head of steam when we're constantly taking money out of that HSA along the way to pay for these little ticky-tack Medicare medical expenses. We're not allowing the HSA to do what it was designed to do, which is to accumulate money on a tax-free basis. So instead of paying for those expenses out of your HSA, pay for those expenses out of pocket. Keep the receipt, and then all of those receipts you can reimburse yourself with somewhere down the line. Now, it is important to keep the receipts because if you ever get audited, you need to be able to show that you had a medical expense that was qualified, and you also need to show that you paid for it. Okay, that's how you can get the qualified reimbursement out of your HSA plan. So, just a little tweak here, and now all of a sudden you can really use all three tax advantages that the HSA confers. A reminder, most people are only taking advantage of two of them. They're getting the deduction on the front end, which is great. It allows you to spend, in this example we've given, 25% more money. You're taking the money out tax-free when you use it for a qualified medical expense, but there isn't really any tax-free interest that's accruing along the way. So why not, like I said, why not pay for your medical expenses between now and when you retire out of pocket? Hang on to those receipts, right? Hang on to those receipts. You can always reimburse yourself later on when you're retired, or if you have a much larger expense, you can just simply use the money that's in your HSA to pay for that larger expense, or to reimburse yourself, like I said. Unfortunately, I think we've been weaned on this idea that, hey, Roth IRAs are great because we accumulate money tax-free and we distribute it tax-free. These investments are designed to do that. Guess what? An HSA is also designed to do that, but it's even better because you get the deduction on the front end. We're always told that you're either going to be taxed on the seed or on the harvest. With the HSA, you are taxed neither on the seed nor on the harvest. The problem is people don't let these HSA accounts grow because they're always spending them down along the way by paying for these little ticky-tacky medical expenses. And they don't let the HSA build a head of steam so that you can really experience that second tax advantage, which is the tax-free interest and the investment earnings. So that is my message for today. It's not a terribly long message, but I think that if we can all just make that little tweak, don't necessarily succumb to the temptation of putting money into your HSA, and then every time you have a little ticky-tack expense, you take the money out. Let that money grow and compound within your HSA. Hang on to your receipts. Hang on to the cost of the bill and then proof that you paid for it, so that if you ever get audited, you have that to back you up. But let that money inside just remember, there's only so many tax-free buckets out there that we can take advantage of. As I've said before, we've got the Roth 401k, the Roth IRA, the Roth conversion. You've got your LIRP. And if you can keep your RMDs low enough, then you can also have your Social Security tax-free. The HSA is another one that we can utilize, but we're just doing it the wrong way. If we start doing it the right way by not necessarily paying for all of our expenses immediately out of our HSA, let's let it build a head of steam, let it grow and compound over time. I think we're going to be taking advantage of all three tax benefits within the HSA. And I want to talk, I've had another podcast where we talk about another tax-free investment. If you're over age 62, you can tap into the equity in your house. You can do a reverse mortgage and also take that money out tax-free. That is a great alternative. That can happen to you. That you can take that money out as long as you live. And so that functions as a way of safeguarding against sequence of return risk. It can help meet lifestyle needs and can help protect against longevity risk as well. I don't want to get off on a tangent, but there are lots of different tax-free streams of income out there. We're not taking advantage of all of them. We should. Okay, that's the show for today. If you are looking for someone to help you navigate all of these different details on how to get to the 0% tax bracket, how to mitigate longevity risk, head on over to davidmcknight.com. We're happy to hook you up with an advisor who is vetted, qualified, trained, personally trained by me in your area. Happy to make that introduction. If you are an advisor who wants to transition your practice to a Power of Zero practice where you can learn how to mitigate tax rate risk and longevity risk within the very same financial plan for your advisors, you can head over to powerofzero.com. Thanks for being on the show this week. We will look forward to chatting with you same time next week.